Your mortgage rate just climbed because of something that happened 12 time zones away. Between November 2024 and November 2025, China reduced its holdings of United States Treasury securities from $700.5 billion to $682.6 billion, the ninth consecutive month of selling. The lowest level since September 2008, when Lehman Brothers collapsed and the global financial system froze. This is not portfolio rebalancing. This is strategic withdrawal from a market that China once dominated with over $1.3 trillion in holdings. Here is what cannot be reversed. China and the United States are locked in a trade conflict where tariffs have reached 145% on Chinese goods and 125% on American goods. This level has appeared exactly once in modern history, the Smoot-Hawley Tariff Act of 1930, which preceded the Great Depression. When the second largest holder of your government's debt begins systematic liquidation while facing the highest tariff barriers in a century, the question is not whether financial markets will react. The question is, what breaks first when a creditor becomes an adversary? I'm John A.G., and this is the Collapse Files. On February 1st, 2025, President Donald Trump invoked the International Emergency Economic Powers Act to impose 10% tariffs on all imports from China, citing fentanyl trafficking as a national emergency. This action triggered a cascade of retaliatory measures that would escalate through spring and into the current standoff. By April 2025, the United States had raised tariffs on Chinese goods to 145%. China responded with 125% tariffs on American products. These are not negotiating positions. These are prohibitive barriers designed to block trade. The economic impact was immediate and measurable. American exports to China fell 28% in April 2025 compared to the prior year. By May, the decline reached 33% year over year. Chinese exports to the United States did not collapse to zero as economic theory would suggest at tariff levels above 70%, but they contracted significantly. The bilateral trade relationship that had defined global commerce for 3 decades was fracturing in real time. Against this backdrop, China's Treasury holdings declined from $688.7 billion in October 2025 to $682.6 billion in November 2025, a reduction of $6.1 billion in a single month. This followed 8 consecutive months of selling. The cumulative reduction since the peak in November 2013 exceeds $634 billion, a 48% decline over 12 years. What had been gradual portfolio adjustment became systematic liquidation as trade tensions escalated. The pattern of selling deserves examination. Between March and November 2025, China reduced holdings every single month without interruption. March saw a decline of approximately $2.3 billion. April registered $3.1 billion. May through August averaged $1.8 billion per month. September recorded $2.9 billion. October showed $11.8 billion. November contributed another $6.1 billion. The total for these 9 months exceeded $30 billion. While individually modest, the relentless monthly reductions signaled deliberate policy rather than opportunistic trading. The timing matters. The November data was released in January 2026 by the US Treasury Department. It showed that China had fallen to the second largest foreign holder of American government debt, behind Japan's $1.259 trillion. The United Kingdom held the third position. The symbolic significance of China's demotion from first to second place cannot be understated. For a decade, China's position as America's largest creditor represented economic interdependence and mutual vulnerability. That era has ended. Market participants began connecting the dots between tariff announcements and Treasury market volatility. Each major tariff escalation coincided with periods of elevated yield volatility and unusual overnight price movements. The correlation was not perfect, but it was persistent enough to generate speculation. When yields spiked 50 basis points in a single week in April 2025, traders immediately questioned whether China was selling aggressively. The magnitude of the move exceeded anything explained by domestic US economic data alone, but the absolute numbers tell only part of the story. China's foreign exchange reserves totaled $3.359 trillion at the end of December 2025. Treasury holdings of $682.6 billion represent approximately 20% of those reserves. Yet the International Monetary Fund's data on global foreign exchange reserves shows that 58% of reserves worldwide are held in dollar-denominated assets. If China followed this global average, its actual dollar holdings could be as high as $1.95 trillion. The discrepancy suggests that China holds substantial dollar assets outside the Treasury market that do not appear in official TIC data. The reduction in Treasury holdings accelerated as tariffs escalated. In the 9 months from February through November 2025, China sold approximately $18 billion in net terms. This pace represents roughly $2 billion per month. Not dramatic by historical standards, but persistent and directional. The selling occurred during a period when the 10-year Treasury yield rose from approximately 3.62% in September 2024 to 4.38% by April 2025. The largest weekly increase in yields in over 2 decades occurred in early April, coinciding with the tariff escalation to 145%. Market participants noticed unusual activity. Bond yields spiked overnight when U.S. markets were closed and Asian markets were active. The 10-year Treasury note gained 50 basis points in a single week in April 2025. The largest move since March 2001. The 5-year note increased 36 basis points. The 30-year bond rose 48 basis points. The steepness of the move and its concentration in overnight trading suggested foreign selling, though attribution remains uncertain due to custodial arrangements and third-party holdings. Treasury Secretary Scott Bessent addressed the speculation in an April 2025 interview. He stated that China had not weaponized treasuries and that such action would not serve China's economic interests. The logic was straightforward. Selling treasuries generates dollars. Those dollars must be deployed elsewhere. Converting dollars to renminbi would strengthen China's currency, contradicting its long-standing weak currency policy designed to support exports. The argument was economically sound but politically contingent. The Court of International Trade declared Trump's tariff executive orders invalid in May 2025, ruling that the use of emergency powers violated statutory limits. The Trump administration appealed. The legal challenges created uncertainty about the permanence of the tariff regime, but did not halt implementation. Tariffs remained in effect while litigation proceeded. The uncertainty compounded market volatility. By October 2025, the United States Trade Representative initiated a Section 301 investigation into China's compliance with the 2020 Phase 1 trade agreement. The investigation concluded that China had failed to meet purchase commitments totaling $200 billion over 2020-2021. This finding provided legal justification for maintaining elevated tariffs, despite the temporary trade truce announced in October 2025, following a meeting between President Trump and President Xi Jinping in South Korea. The truce established a 1-year framework under which tariffs would remain at 47.5% on Chinese exports to the United States, down from the peak of 145%. In exchange, China suspended export controls on rare earth minerals and pledged to resume purchases of American agricultural products. But the agreement was fragile. In January 2026, Trump threatened 25% tariffs on countries doing business with Iran, China's largest oil supplier. The threat jeopardized the truce and signaled that tariffs would remain a primary tool of American foreign policy. The United States Treasury market functions as the foundation of global finance. Total outstanding Treasury securities equal $28.1 trillion, approximately the size of U.S. gross domestic product. Foreign investors hold $8.5 trillion, or 30% of the market. This foreign participation provides critical demand for American government debt, allowing the United States to run persistent fiscal deficits without triggering bond market crises. China's role in this system evolved over 3 decades. Beginning in the 1990s, China accumulated dollar reserves through its export surplus with the United States. Chinese exporters received dollars for goods sold to American consumers. Those dollars were converted to renminbi through the banking system and ultimately absorbed by the People's Bank of China. The central bank held the dollars as foreign exchange reserves and invested them primarily in U.S. Treasury securities. This arrangement created a circular flow. American consumers borrowed to purchase Chinese goods. China lent those dollars back to the United States by buying treasuries. American interest rates remained low because foreign demand absorbed government borrowing. Low rates supported consumption, which generated more imports from China. The cycle was self-reinforcing and mutually beneficial as long as both sides valued stability over strategic advantage. But the system contained an asymmetry. China needed access to American consumers more than America needed access to Chinese savings. If China stopped buying treasuries, American interest rates would rise, but the impact would be distributed across the entire global bond market. If America imposed tariffs that blocked Chinese exports, Chinese factories would lose their primary customer with no immediate substitute. The asymmetry meant that China's leverage through treasury holdings was less potent than commonly believed. The mechanics of selling treasuries further constrained China's options. When China sells a treasury bond, it receives dollars. Those dollars must then be deployed into another asset. The choices are limited. Converting dollars to renminbi strengthens the currency and makes Chinese exports more expensive. This contradicts the export-oriented growth model. Buying other dollar assets, such as corporate bonds or equities, exposes China to greater volatility and credit risk. Buying euros or yen diversifies currency exposure, but requires finding counterparties willing to absorb large transactions without moving prices significantly. The most viable alternative is gold. Central bank gold purchases totaled 863 tons in 2025, according to the World Gold Council. China participated in this accumulation, though official reporting understates actual purchases. Gold provides a non-dollar reserve asset without currency risk, but gold markets are smaller than treasury markets. Rapid accumulation would drive prices higher, reducing the purchasing power of reserves. The National Bank of Poland holds 550 tons valued at approximately $30 billion at recent prices. China's $682.6 billion in treasuries would require over 12,000 tons of gold to replace at current prices. Annual global mine production is approximately 3,000 tons. The math does not work for wholesale substitution. The institutional structure also matters. The People's Bank of China operates under political oversight, but maintains operational independence and reserve management. Strategic decisions about treasury holdings involve the State Administration of Foreign Exchange, the Ministry of Finance, and senior Communist Party leadership. Selling treasuries as a geopolitical weapon would require high-level authorization and acceptance of economic costs. Such a decision would not be made lightly or reversed easily once implemented. The parties trapped in the system are exporters, importers, and financial intermediaries. Chinese exporters facing 145% tariffs cannot compete in American markets. They must find new customers in Europe, Southeast Asia, or domestic markets. The transition takes time and generates losses. American importers who relied on Chinese supply chains face higher costs and disrupted logistics. They must source from alternative suppliers at premium prices or absorb margin compression. Financial institutions that facilitate trade and hold treasury positions face volatility in bond prices and uncertainty about future flows. China's treasury holdings peaked at $1.167 trillion in November 2013. As of November 2025, holdings stood at $682.6 billion. The decline totals $634.1 billion over 12 years, an average reduction of $52.8 billion per year. But the pace was not constant. Holdings remained relatively stable between 2014 and 2018, declining by approximately $100 billion. The acceleration occurred after 2018, when the first Trump administration initiated the initial trade war. Between 2018 and 2020, China reduced holdings by roughly $200 billion. The pace slowed under the Biden administration, but resumed in 2024 and 2025. The 9 consecutive months of selling from March through November 2025 represents a new pattern. Prior reductions were episodic and often reversed. The sustained directional selling indicates a strategic shift. Monthly declines average $2 billion, modest in absolute terms but significant in aggregate. If this pace continues, China would reduce holdings by $24 billion annually, reaching approximately $658 billion by the end of 2026. The ratio of treasury holdings to total foreign exchange reserves provides insight into portfolio allocation. In November 2025, China's $682.6 billion in treasuries represented 20.3% of its $3.357 trillion in reserves. This compares to 58% for global reserves on average. The underweight position suggests China has already diversified significantly away from treasuries. The remaining holdings may represent a minimum operational allocation needed for trade settlement and liquidity management. Japan's holdings offer a useful comparison. Japan held $1.159 trillion in treasuries as of recent data. Japan's foreign exchange reserves total approximately $1.2 trillion. Treasury holdings represent over 90% of reserves. This concentration reflects Japan's different strategic calculus. Japan values the US-Japan security alliance and does not face comparable trade tensions. The willingness to hold such a high treasury concentration underscores that China's lower allocation is a deliberate choice. The United Kingdom's position as the third largest holder introduces complexity. The UK holds treasuries on behalf of clients through its role as a financial center. Much of the UK's reported holdings may actually belong to other countries, including China, using London as a custodial center. This custodial bias in the TIC data means that China's actual treasury holdings could be higher or lower than reported figures. Without transparent attribution, precise measurement remains impossible. Yield movements correlate with selling pressure. The 10-year Treasury yield stood at 3.62% in September 2024. By April 2025, it reached 4.49%, an increase of 87 basis points in 7 months. The move accelerated during tariff escalation, with a 50 basis point weekly surge in early April. The timing suggests that foreign selling, potentially including China, contributed to yield volatility. Higher yields increase borrowing costs for the U.S. government, corporations, and consumers. Each 100 basis points in yield translates to approximately $280 billion in additional annual interest expense on the existing federal debt of $28 trillion. Mortgage rates track the 10-year Treasury yield. When the 10-year rose to 4.49%, mortgage rates exceeded 7%. This level prices out many potential home buyers and weakens housing demand. Real estate markets began showing stress with home sales declining and inventory increasing. The transmission from Treasury yields to mortgage rates, to housing activity, to consumer spending, creates a feedback loop that amplifies economic impact. The dollar index provides another data point. The dollar strengthened modestly during the tariff escalation, gaining approximately 2% from January through April 2025. A stronger dollar makes American exports less competitive and increases the real value of dollar-denominated debt held by foreign countries. For China, a stronger dollar means that its treasury holdings are worth more in renminbi terms, but also that servicing any dollar debts becomes more expensive. Trade balance figures reveal the impact of tariffs on actual commerce. The US trade deficit with China narrowed from approximately $400 billion annually before tariffs to roughly $250 billion by late 2025. The reduction came not from increased American exports, but from decreased Chinese imports. American consumers shifted purchases to Vietnam, Mexico, and other suppliers. Chinese exporters redirected goods to Europe and developing markets. The bilateral imbalance decreased, but the overall U.S. trade deficit remained largely unchanged. This pattern confirms that tariffs redistribute trade flows rather than eliminate deficits. Corporate bankruptcy data shows secondary effects. U.S. corporate bankruptcies increased to the highest level since 2010 by the end of 2025. Many failures occurred in import-dependent sectors facing higher input costs due to tariffs. The correlation between tariff implementation and bankruptcy filings suggests that trade policy contributed to financial stress. The lag between tariff imposition and business failure means that additional bankruptcies likely lie ahead as companies exhaust working capital. The Smoot-Hawley Tariff Act of 1930 provides the most relevant historical parallel. Signed into law on June 17, 1930, the act raised tariffs on over 20,000 imported goods to record levels, averaging 40 to 60%. The intention was to protect American farmers and manufacturers from foreign competition during the early stages of the Great Depression. The result was retaliation. Trading partners imposed their own tariffs on American goods. Global trade collapsed by approximately 65% between 1929 and 1934. The contraction in trade deepened the Depression and prolonged the recovery. The economic logic of Smoot-Hawley parallels the current trade war. Policymakers believed that tariffs would create domestic jobs by making imported goods more expensive. In practice, tariffs raised costs for consumers and businesses that relied on imports. Retaliation destroyed export markets. Industries that depended on export demand contracted. The net effect was negative for employment and output. Economists now widely agree that Smoot-Hawley worsened the Depression. The lesson was codified in the post-World War II creation of the General Agreement on Tariffs and Trade, designed specifically to prevent a repeat of 1930s protectionism. The current tariff levels between the United States and China exceed Smoot-Hawley in magnitude. A 145% tariff effectively bans trade. Historical experience offers no examples of economies thriving under such prohibitive barriers. The only comparable periods involve wartime embargoes designed to destroy enemy economies rather than extract negotiating concessions. The use of tariff levels associated with economic warfare in a peacetime trade dispute represents a category error with unpredictable consequences. The 2018-2020 trade war under the first Trump administration offers a more recent precedent. Tariffs on Chinese goods reached approximately 20% on average, covering 60% of bilateral trade. China retaliated with tariffs on American agricultural products, particularly soybeans. American farmers lost access to their largest export market. The U.S. government compensated farmers with $28 billion in direct payments between 2018 and 2020. The subsidies prevented immediate bankruptcies but did not restore market access. When the Phase 1 agreement was signed in January 2020, it included Chinese commitments to purchase $200 billion of American goods over 2 years. China failed to meet those commitments, purchasing only approximately 60% of the target amount. The Phase 1 failure demonstrates the limits of coercive trade policy. Tariffs can inflict pain, but they cannot compel compliance with detailed purchase requirements. China faced domestic economic pressures, including COVID-19 disruptions and property sector weakness. Importing expensive American goods to satisfy political commitments would have worsened those pressures. Beijing chose to accept the breakdown of the agreement rather than subordinate domestic economic management to external demands. This precedent suggests that the current trade truce, which also includes purchase commitments, faces similar credibility challenges. The consequences of the 2018-2020 trade war extended beyond agriculture. American manufacturers that relied on Chinese components faced supply chain disruptions. Companies absorbed higher costs, passed them to consumers through price increases, or accepted compressed margins. Small and medium-sized businesses without sophisticated supply chain management capabilities suffered disproportionately. Many lacked the resources to quickly source from alternative suppliers or redesign products to avoid Chinese content. Employment in manufacturing did not increase as promised. Despite tariffs designed to reshore production, manufacturing employment remained essentially flat between 2018 and 2020. Some production shifted from China to Vietnam, Mexico, and other low-cost countries. Little returned to the United States because labor cost differentials remained prohibitive. A Chinese factory worker earning $5 per hour could not be replaced economically by an American worker earning $25 per hour, regardless of tariff levels. Consumer prices reflected the tariff impact. Studies by the Federal Reserve and independent economists concluded that American consumers and businesses paid the full cost of tariffs through higher prices. The tax incidence fell on domestic purchasers, not foreign exporters. This contradicted the administration's claim that China was paying the tariffs. The finding was economically predictable, but politically inconvenient. Japan's experience with U.S. trade pressure in the 1980s provides another angle. The United States imposed voluntary export restraints on Japanese automobiles and pressured Japan to open its markets through the Structural Impediments Initiative. Japan complied with many American demands, appreciating the yen, investing in U.S. manufacturing facilities, and purchasing more American goods. The accommodation prevented a full-scale trade war, but contributed to Japan's economic stagnation in the 1990s. The Plaza Accord of 1985, which forced yen appreciation, is widely cited as a factor in Japan's subsequent lost decade. China appears to have studied this history and concluded that accommodation leads to subordination. The mainstream narrative frames China's treasury selling as either retaliation or diversification. Both explanations contain truth, but miss the deeper strategic shift. China is not simply reducing treasury holdings. It is fundamentally restructuring its economic relationship with the United States from interdependence to strategic autonomy. This requires building alternative trade relationships, developing domestic consumption, and creating financial infrastructure independent of dollar dominance. The Belt and Road Initiative represents the trade dimension. China has invested over $1 trillion in infrastructure projects across Asia, Africa, and Europe since 2013. These projects create demand for Chinese exports, secure access to resources, and build political influence. The initiative reduces China's dependence on American consumers by cultivating alternative markets. While many projects face financial difficulties, the strategic logic remains sound. Diversification away from U.S. market dependence protects against future trade disruptions. The financial dimension involves creating alternatives to dollar-based payment systems. China's cross-border interbank payment system launched in 2015 as a potential competitor to SWIFT. CIPS processes renminbi transactions and allows countries to bypass dollar settlement. Adoption has grown gradually, particularly among Belt and Road participants and countries seeking to reduce exposure to U.S. financial sanctions. The system remains small compared to SWIFT, but its existence provides optionality that did not exist a decade ago. The currency diversification extends beyond gold. China has expanded currency swap agreements with dozens of countries, allowing bilateral trade settlement in renminbi rather than dollars. These swaps totaled over 3.5 trillion renminbi by 2025. While most trade still occurs in dollars, the infrastructure for alternatives exists and can scale if geopolitical pressures increase. The renminbi's share of global foreign exchange reserves has grown from near zero in 2010 to approximately 2.5% by 2025. Still small, but directionally significant. The domestic consumption story often misses the structural obstacles. Chinese household consumption represents approximately 38% of GDP, compared to 68% in the United States. Increasing consumption requires fundamental reforms to the social safety net, particularly pensions and healthcare, to reduce precautionary savings. Such reforms are politically complex and fiscally expensive. Beijing has announced intentions to boost consumption for over a decade without achieving significant structural change. The export-oriented model persists because alternatives are difficult to implement. The demographic context also matters. China's working-age population peaked in 2015 and has declined since. The one-child policy created an aging society with fewer workers supporting more retirees. This demographic structure limits consumption growth potential and increases the burden on state pensions. Japan faced similar demographics in the 1990s and responded with massive government borrowing to sustain demand. China may follow this path, but the debt levels would constrain other policy options. The political dimension involves regime legitimacy. The Communist Party's claim to rule rests on delivering economic growth and rising living standards. Trade wars that reduce growth threaten this legitimacy, but capitulation to American demands also threatens legitimacy by appearing weak. Xi Jinping's leadership has emphasized national rejuvenation and resistance to foreign pressure. This political posture constrains economic flexibility. The trade war becomes a test of political will, as much as economic policy. The media narrative in both countries reinforces domestic political incentives. American media emphasizes China's unfair trade practices, intellectual property theft, and authoritarian governance. Chinese media emphasizes American hegemony, protectionism, and attempts to contain China's rise. Both narratives contain elements of truth and considerable exaggeration. The rhetorical escalation makes compromise politically difficult for leaders on both sides. What begins as trade policy hardens into national identity. The global impact extends beyond bilateral relations. Other countries face pressure to choose sides. American allies in Europe and Asia must balance economic ties with China against security commitments to the United States. The choice is not binary, but Washington increasingly frames it that way. Export controls on semiconductors, restrictions on Chinese investment, and sanctions threats force governments to prioritize. The result is a fragmenting global economy where trade flows increasingly follow geopolitical lines rather than comparative advantage. China's sustained reduction of treasury holdings signals the erosion of the post-Cold War consensus that economic integration would prevent great power conflict. That consensus assumed that mutual economic dependence created incentives for peaceful resolution of disputes. Globalization was supposed to make war obsolete by raising its costs beyond any rational calculation. The current trajectory suggests that assumption was wrong. Economic interdependence can become a source of vulnerability rather than mutual benefit when trust breaks down. The breakdown of trust appears first in financial markets. When participants believe that assets might be frozen, sanctioned, or used as political weapons, they reduce exposure. China's treasury selling reflects this calculus. Holding $682 billion in securities issued by a government that might freeze those assets creates unacceptable risk. The precedent of freezing Russian foreign exchange reserves in 2022 demonstrated that dollar assets are conditional on political favor. This lesson resonates with every country that fears future sanctions. The confidence crisis extends beyond China. Central banks worldwide are reducing dollar reserve allocations. The dollar's share of global foreign exchange reserves has declined from approximately 72% in 2000 to 57% by 2025. This shift represents a multi-decade trend, but the pace has accelerated. If central banks continue diversifying at current rates, the dollar could fall below 50% of reserves by 2030. At that point, it would lose its status as the unambiguous global reserve currency. The liquidity implications are profound. Treasury markets function because of deep liquidity provided by diverse participants. Foreign central banks, domestic institutions, individual investors, and hedge funds all provide bids and offers that keep spreads narrow and prices stable. When a major participant like China systematically sells, liquidity decreases. Bid-ask spreads widen. Price volatility increases. The market becomes less efficient at absorbing new government borrowing. Higher volatility increases the term premium that investors demand to hold long-dated securities. The term premium compensates for uncertainty about future interest rates and inflation. When that premium rises, the entire yield curve shifts upward. Higher yields increase a government interest expense, which widens fiscal deficits, which require more borrowing, which further pressures yields. The feedback loop can become self-reinforcing under conditions of stress. What breaks first, historically, is confidence in the ability to exit positions at reasonable prices. The 2008 financial crisis demonstrated this dynamic in mortgage-backed securities. When investors lost confidence in valuations, they attempted to sell simultaneously. No bids appeared at any price. Markets froze. The same dynamic could occur in treasuries if a major shock triggers simultaneous selling by foreign holders. The Federal Reserve would likely intervene through quantitative easing, but the political cost of such intervention during a crisis would be substantial. The geopolitical implications are equally concerning. When economic ties weaken, the costs of military conflict decline. Trade creates stakeholders in peaceful relations. Business interests lobby against war because it disrupts commerce. When trade is already disrupted by tariffs, those interests lose influence. The marginal cost of further escalation decreases. This does not make war inevitable, but it removes a restraint that previously operated. Taiwan represents the most likely flashpoint. China considers Taiwan a core national interest and has never renounced the use of force for reunification. The United States has maintained strategic ambiguity about whether it would defend Taiwan militarily. Economic integration between the United States and China previously made the costs of conflict over Taiwan prohibitive. If economic ties continue deteriorating, that calculation changes. The trade war and treasury selling are indirect indicators that both sides are contemplating future conflicts where economic interdependence no longer constrains military options. On November 2025, China held $682.6 billion in United States Treasury securities, the ninth consecutive month of reductions, the lowest level since September of 2008. This occurred against the backdrop of a trade war where tariffs reached 145% on Chinese goods and 125% on American goods. The combination of sustained treasury selling and prohibitive trade barriers signals a fundamental restructuring of the US-China relationship from cooperation to competition. The mechanics of this restructuring are clear. China is diversifying reserves away from dollar assets. The United States is reconfiguring supply chains away from Chinese production. Both sides are building alternative relationships and institutions. The process is gradual but directional. Each month of treasury selling and each round of tariff increases, reinforces the trend. Reversal becomes progressively more difficult as sunk costs accumulate and domestic constituencies adjust to the new reality. The implications extend beyond bilateral relations. The erosion of the largest trading relationship in history creates uncertainty about the future of globalization. If the United States and China cannot maintain stable economic ties, what hope exists for broader international cooperation? The answer may be that cooperation fragments into regional blocs, organized around geopolitical alignment rather than economic efficiency. This outcome would reduce global growth, increase costs, and create new sources of conflict. The financial market consequences are already visible. Treasury yields have risen, mortgage rates have climbed, corporate borrowing costs have increased. These changes reflect reduced foreign demand for American debt and increased uncertainty about fiscal sustainability. The trajectory points toward higher structural interest rates, slower economic growth, and elevated financial volatility. These conditions create risks for over-leveraged businesses, homeowners with variable rate debt, and retirees depending on fixed income portfolios. The path forward depends on political decisions that remain uncertain. The trade truce announced in October 2025 provided temporary relief, but did not resolve underlying tensions. Tariffs remain elevated. Trust remains low. Future escalation remains possible. President Trump has threatened additional tariffs related to Iran, European trade, and other issues. Each threat reinforces the pattern that trade policy serves political objectives rather than economic optimization. China faces its own constraints. Demographic decline, property sector stress, and local government debt all limit Beijing's options. Aggressive retaliation against American tariffs could accelerate capital outflows and destabilize domestic markets. But accommodation to American demands risks political backlash and regime legitimacy. The leadership must navigate between economic pragmatism and political survival. That navigation becomes more difficult as nationalist sentiment hardens on both sides. The $682.6 billion in Treasury holdings represent more than financial assets. They represent the residual interdependence between two economies that are gradually decoupling. Each $1 billion sold reduces that interdependence slightly. At current pace, China would exit Treasury holdings entirely within 30 years. But major shocks could accelerate the timeline dramatically. A crisis over Taiwan, a financial market disruption, or a political decision to weaponize reserves could trigger rapid liquidation with cascading consequences. The mechanism designed to finance American fiscal deficits through foreign savings is losing its largest participant. That loss will not happen overnight, but it is happening steadily. What replaces Chinese demand remains uncertain. Domestic savings must increase, spending must decrease, or the Federal Reserve must intervene more directly. None of these options are painless. All impose costs on different constituencies. The political system will determine how those costs are distributed. This is not financial advice. This is pattern observation. The pattern shows two great powers with deeply intertwined economies choosing strategic competition over cooperation. The choice may prove reversible if circumstances change and leadership shifts. But the current trajectory suggests that what cannot be undone is the mutual recognition that economic interdependence creates vulnerabilities that can be exploited. Once that recognition becomes embedded in institutional behavior, trust is difficult to restore. The Treasury holdings will continue declining. The trade barriers will remain elevated. The financial markets will adjust to a world where the second largest economy systematically reduces exposure to the largest. What that adjustment reveals will define the next decade of global finance.